Good morning, everyone, and welcome to the daily plan for today, Wednesday, FOMC day. And just thrown in to keep things interesting, we have, as everyone knows, Trump meeting Xi tomorrow, and he's in South Korea now. And I'm sure there's a microphone near him, and so ... but whatever that means. So some of you may notice this. I know it's hard to see. So we have our favorite icy whale, aka Captain Condor, back again today. And I'll give a brief explainer for those who aren't familiar exactly. So the icy whale, or Captain Condor, is a small hedge fund, has a small hedge fund, but basically has a subscription service where he and his minions sell 0 DTE, or actually 1 DTE on market close, iron condors, 5 or 10 wide. The 10 wides tend to be about 1/4 to 1/3 the size of the 5 wides under certain conditions systematically. If they lose, they double up, actually not exactly double, they follow a certain progression of sizing up until they either go broke or win. So far, they haven't gone broke. And so here we are again after, I don't know how many, 5, I think, successive losses, or 4. Now the 5 white people didn't close out yesterday and won. The 10 white people closed out yesterday, like, I don't know, at around this time somewhere, 3 o'clock-ish, 3:30, when we were like up near the high of the day, and they closed out. They took a loss. The 5 white people hung on, and they were short the 95s, the 68.95, so they won. So now they've sized up, and there's 12,000 contracts, call credit spreads at 69.15.25, and put credit spreads at 68.50.40. 12,000 sitting there. So what does that mean to you and me and to us SPX traders? Well, what that means is, in theory, this is an edge that's set. As we go up, market makers have to hedge heading into this direction. And as we pull away, they have to buy. That action gets stronger as time to expiration gets closer. Same story at the bottom. As we head down, the market makers have to buy to flatten their deltas. As we head away, they have to sell. And again, time of day matters, so that whole dynamic gets stronger as we get closer to expiration. We'll call it the effect of charm, the natural decay process, but it's also the effect of gamma, because gamma, or the rate of change of delta, or how much the market makers have to hedge, is affected by 2 primary inputs. It's affected by how close we are to expiration. So 1 hour versus 1 day versus 1 week versus 1 month. Think of gamma as the convexity, or the rate of change of the delta of delta. So think, if you're long an option, if you're long an at the money or slightly out of the money call in whatever stock that's a week from now, and the stock goes up 1%, that call will appreciate more than one that's 6 months from now. And that's the gamma effect. Anyway, so that's the setup here. So there's a few key levels here, and this is a trading view string where I take my daily plan, and I just kind of put it into a string so I can see it on my trading view. Good morning, Danny. I can see it on my trading view, so it's just kind of easier to trade. And so, and then we'll look at the options depth, and we'll look at some other gamma things to show you where this is derived from. Let's just play with it on the chart for once. Okay, so here's the call credit spread, and that's so far that's serving as a at the top. To the downside, we have this 6,900. I'm calling it a magnet. It's a round number. There's going to be a lot of action around there. So that's 6,900. 68.95, roughly yesterday's close, is an inflection point, and that's the next biggest cluster of options other than this iron condor on the board, and it's market makers short gamma. It could be customers long calls, it doesn't matter. Customers buy them, market makers sell them, they're short. So that has a certain accelerant flow, pull to it. So it could pull us down toward it from below, from above. It could pull us up toward it from below, as long as it stays there. Now that's close enough to where we are that it might get transacted away. And what I mean by that is people are going to buy and sell options. A lot of times these positions get eaten through during the day, and we get the updates, and we go through it in my server, blah, 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 shameless plug. And so we see it. Sometimes I tweet it out when there's time, sometimes I don't. When there's a big position change that's significant, I try to let the trading public know. It's kind of a public service, so to speak, but I can't always do it. I also trade my account pretty actively, 20, 40, 50, 60 SPX trades a day is not unusual for me. So, yeah. Anyway, and so that's the inflection point here. And then down below this 68.95, there's really not a lot in terms of positioning to hang your hat on, other than there's kind of a cluster of positive gamma in here, so we shouldn't really go down that far. Here's the bottom of the expected move. When I checked it earlier today, we have an expected move of 35. And for those of you that aren't familiar, the expected move is simply how much the options market prices in that we're going to move, and that's determined really simply. You look at the straddle price of the at the money or at the money-ish. You might not, since we're not exactly going to always be exactly at the same price, just grab the closest price, put in call, add up what they cost, and that's going to be the straddle price. And that deteriorates in theory throughout the day. However, on an FOMC day, those straddles typically don't decay. They pretty much stay where they are until the announcement, and then we go crazy. And then we have the press conference, and we go crazy again. Then we have Thursday, the post FOMC potentially crazy adjustment, and then we party on from there. So and today I don't sell iron condors. Many of you know that I'm an iron condor seller. I don't sell iron condors on these kind of days. I'll scalp. I'll play with a butterfly. I'll mess around with something longer term, an individual stock or something. I might take profit on something if I have some that I have like baking somewhere, but I'm not going to play with these people on FOMC day. Even though it looks like what we have. Joel, my buddy Joel, long time no see. My buddy Joel from my Mentor Q days, my lunchman. Yes, I don't want to play with these people. Now, most of us know what we think we know, and the market thinks it knows. It's going to be a quarter point in October, a quarter point in December. At least that's what it is now. And there's talk about QT, quantitative tightening, ending So that should loosen things up. From what I read, there's a 50-50 chance, or that's at least the market make the market's bets. I don't know. I'm not a macro bro. If my boy Tim was here, I'd ask him what he thinks. I did ask him, I had a little chat with him this morning, and long story short, he doesn't think that all this repo overnight as a SOFR rate and all that kind of thing is going to have a big effect on the SPX, on the overall market. Might have a little algo thing for a day or two or some BS, but it's not going to really matter, he says. And so I'm just going to go with that with an asterisk in the back of my mind. You also met for earnings. Yeah. Thank you for mentioning that. Yeah. So on top of everything else, Trump and Xi with the microphone in South Korea and the FOMC and the announcement and the press conference, we have Mag 4 of 7 earnings today. And I think it's, who is it? Meta, Google. I know I have a Meta trade and maybe Micro. I forgot, I have it in my note. Let me see who it is. I bet you Joel has it handy. Let me see who it is. Let me pull up my note. And you guys can discuss amongst yourselves. Okay, where's my note? Google, Meta, Microsoft. Am I missing one of the 4? I have Google, Meta, Microsoft in my notes. I could be missing one. It wouldn't surprise me. Anyway, we have some MAG earnings today, so that's going to add a little spice. And on top of that, in case you're living under a mushroom somewhere, there's this obscure company called NVIDIA. I'll have to put some discount links in there, and hopefully I can find mental cues this. Now this hasn't been working lately for some reason. Okay. This has been working. Okay. Here's mental cues, levels. Where's my little thing here? I just want to get NVIDIA chart on there, and you see it's through all the levels. There's no level here. It's through 200, like a knife through butter. On the announcement that basically they're going to be able to sell chips to China, or so we think. And plus, they had a deal with someone, I don't know, I think they announced like $500 billion worth of orders. 500 billion with a B. 205 call for NVIDIA. Well, okay, we'll see if they breach. Oh, Lynn, just for fun, while we're talking about NVIDIA, then we'll circle back. Let's go to, who haven't I looked at in a while? Let's go look at Gamma Edge. I use about 5 services. I don't calculate this crap myself. I use 5 services, and let's just say I mentally triangulate it. Good morning. I mentally triangulate it. But for, anyway, let's see what we have for NVIDIA. So 200 is the largest wall, so to speak, and we're through that. Here was the COTMP. So they have 205 as an inflection point. Yeah, for the weekly. What does the monthly look like? Monthly, we have this down here at 180. And they have this. So COTMP and COTMC is Gamma Edge's verbiage for this is where we should bounce or fail to go down to the next level. And this is where calls go in the money and we chase. And so there's like a 205 to 215-ish zone. I'm not going to mess with NVIDIA anyway, so it doesn't really matter. So this wall would have to be overtaken, and then it's kind of whoop. Yeah, let's see how Mentor Q has it. I haven't logged into this in a while. Forgot even how to use this. Indices and stocks, okay. Where's NVIDIA? Let's see. Oh, man. I know I have it on my list here somewhere. It'd probably be easier for me to just type the symbol in. NVDA, let's see what they have. That's what Joel was referencing. Yeah, so everybody kind of has 200 in one way or another, and we're over that. And I guess on the weekly, 205 is the next level, and we're through it. Yes, everybody has more or less the same numbers because everybody's looking at the same data. So there's not really any magic. Okay. Now let's go over here. So here we are at options depth now. And here's what my plan was derived from. Not that you really care. I mean, maybe you do, I don't know. But let's talk about this based on the plan. About the plan based on this. So here's the IC whale trades. So once again, I just go through this every day just to kind of remind people and review it. This is where market makers are long gamble. They own these options because somebody sold it. In this case, the IC whale. That's long gamble. So when somebody sells an option, market makers are long gamble. So what does that mean? It's a nice sounding word. That means that as we approach this level from below, market makers have to sell to flatten their delta. They're too long. Market makers want to stay delta neutral. Unlike popular opinion and conspiracy theories, they don't drive the market. They don't conspire to pin it anywhere. It's all mechanical. It's all formulas. Sorry, there's no grand conspiracy by market makers to steal your money. If you lose your money, it's not because of them. It's because of you. I hate to tell you that. And you can DM me and excoriate me on Twitter for saying that if you want. That's fine. So as we go up, they hedge, they sell. And then as we go away, we're selling because our deltas are too long. We want to be delta neutral. We don't want exposure risk to movement of the SPX. We just want our money from the options we sold you. That's all we want. We want to keep the premium we got, and we're going to hedge by buying and selling futures to keep that edge. That's our job. And as we move away, oh shit, now we're too short. We sold all these futures up here, and then we dropped 10 points, and now we're too short. Now, early in the day, that difference isn't as much. As time progresses, that difference becomes more, becomes greater. And so then that action of selling as we approach and buying as we go down accelerates, especially when there's a large node like this. And we saw that the last few days. End of the day, we were near one of these strikes at the top. That's where the IC whale was. He got harpooned for a few days in a row. And as we go down, they buy. And then what's been happening typically at the end of the day, more and more, whatever it is, programmatic trading, systematic, discretionary, I don't know who it is. You start seeing these 1,000 lots coming in right near where spot is and driving the market into the close 5 or 10 points one way or another, often around a large number. Sometimes they're targeting, it looks like some of these short strikes, this is too big to target. So they might target above it or below it to get through it or to push it, around it. Yesterday, there were big trades at the 6,900 puts when we were up at 6,905 or 6,910 toward the end of the day. I think there might have been something at 6,990. And they looked like losers. They looked like schmucks until all of a sudden we went down 10 points. They made a lot of money. Okay, so and same thing happens from the bottom. If we're going down, if we're near 65 beyond the expected move, if we're 65 beyond the expected move, and we head here, market makers have to buy, but then as we go up, they have to sell. But it's not just this in isolation. There's something else in the equation. There's these market maker longs. And so as we go down, this becomes an attractant, a hedge in the direction of the move. Then as we go below it, they buy into the direction of the move. So you have this kind of triangular dynamics, and you have this 6890, 6900, and 6895. I call it a butterfly looking structure, 1, 1, 1 in the middle. And that sometimes becomes a penny area, not a pin necessarily at the end of the day, but a chop area for a while until something resolves, until somebody buys more here or there, or there's also real money trading, until somebody decides to buy 2 million shares of Apple or sell this, or something happens, quote unquote, in the real world. Remember, gamma is path dependent, depends on where the market moves. The market moves partially on this, but this is more around the edges. The market moves because people are buying and selling billions of dollars. The other thing that's going on, I'll take a look at that in a minute, Joel. Okay. And I haven't looked. Let's just take a look. The amount of gamma expiring at the end in October is large. And it's 2 or 3 days from now. Because remember, gamma is dependent on how close we are. So, of course, the closest end of month expiration is going to be huge. And the November, which is much larger in the number of contracts, is going to be small because of the time factor. That's a very good question. Short answer, 59.95. Let me throw a link in there, and we're going to be running this special, and it'll be a 3-month special. Let me throw a link in there. Shameless plug. I suppose I should have it in there. Links I need handy. See, totally transparent. But the special will be on a 3-month deal, and if you here we are. Copy link. No, not copy link. Let's do copy text. Copy link. It brings you here. Copy text. He is well worth it. Thank you, Joel. Yeah, Joel is my buddy from back in the day. We used to get into these interesting little TA price action versus gamma or whatever discussions. Anyway, so that was NVIDIA. Let me, I'm jumping around, but that's kind of how I do. And, it chopped. I said 95 to 25 is the chop zone. And that's more the expected move. It's going to be hard to get above these guys. I'll give them credit. It's going to be hard to get above these guys. I put my subscription link in there. And the special will be a 3-month special. It'll be the same dollar amount. Yeah, it'll be the same dollar amount, but the 3-month special will also get you access to the unusual whales bot we have. I'll get you access to the ES scalping room. I'll get you access to some of the bells and whistles. And if you subscribe now, I'll just make sure that you get that 3-month deal if you want. Subscribe now, as they say on the commercials. Anyway, let's get back to where we are. So yeah, but Joel is right. Once this is gone, we have a new regime, but there's a lot of gamma expiring, and that's gonna kind of keeping us pinned, keeping us moving, and the direction it's keeping us moving is up. Direction it's been keeping us moving is up. Now, another thing about the going up, and so there's institutional research that I get access to that I read, and you see snippets of it on Twitter or wherever you look around in your discords. And one of the ones, and again, this is no big secret, is that the corporate buyback window, i.e., when you hear the earnings announcement and you hear Microsoft is going to buy authorized to buy $20 billion of their stock, or $50 billion, this one, that one, the buyback window has been basically shut and is opening. It's already been opening, and it will open. It's typically 2 days after they report. So think October 30th, November 1st, November 2nd, next week. Whatever all these big multi-trillion-dollar companies have authorized to buy back, that window opens. Doesn't mean they're going to all jump in to buy it back that day, but that window opens. That's liquidity coming in. And liquidity drives the market. Let's face it. It's supply and demand, buy and sell. You have automatic buyers waiting at a price, and then buyers waiting at a price. Okay, so that's one tailwind. I'm talking about not today, and we just shifted gears to a longer time frame. So that's one thing that's going on. Since we're talking about a longer time frame, let me just change views to over here. Because here I can look at a longer time frame more easily. Okay, so that's one factor. Now, other institutional research indicates that, you know how the algos are on the trend following ones. When we had that downwhoosh a week or two ago, like that early October, that mid-October bear market for 3% for a week, tongue in cheek. The hedge funds, everybody lightened up, and there's actually people net short now. Now they have to chase. And some of them, like the volatility funds that adjust their allocation based on realized volatility versus implied volatility. Well, realized has been, if not outpacing implied, been running neck and neck with it, and they have different, trend comparisons, 1 month versus 10 days versus 3 months versus 6, whatever it is, and nobody really knows. Everybody has estimates, and I trust Goldman Sachs's or Nomura's estimate better than mine. Long story short, they're underallocated. Long story short, they have to buy at some point. Trend following. So there's actually right tail chasing. They're hedging for the right tail, for the upper side of the distribution, which we saw before. We saw that after the May sell-off. We see this shit all the time, pardon my French. Sometimes it amazes me how these smart people could be so, whatever, short-sighted. Let's use that word. So here we have 7,000 strike calls for the 31st times 5,000 and 69.95s. So there's there's bets that shows the market making short, customer long. There's bets that we're going there by Friday. There's bets that we're going there by the 5th. There's bets that we're going there. If we look here, we have stuff up at 70.50. And if I expand it, I'm not going to go through this whole exercise right now. But if I expand this just for fun, we'll go through it a little bit to December 31st. And let's go up to some crazy number. Let's go up to 75.50. Let's go up to a real crazy number. It'll take a second to load. Discuss among yourself. Okay, I'm going to get to this question in a minute. Okay, so let's see what's going on up in the sky. Okay, and remember JP Morgan collar is at 7,000. And we just about always overtake it. And so we have this at 7,000. This is customer shorts, but if we're over here, they become market maker long, they become magnets. Nothing that big above 7,000 yet. You got a little crap up at 7,500. We're not going there. Okay. And this is thin. These weeklies are thin. Let's pull it back to today. Whoop. Let's pull it back to something normal. Okay, let me see this question again. For these IC calls, market makers are long the 15. So what exactly is their hedge? They sold futures. So if it approaches it, what do markets? Okay, so you can explain it. Okay, so let's walk through it again. Okay, so the easiest way to think of it, a way that's easier for me to think of it, is market makers are doing kind of what the customer is doing. So the customer is selling delta, so they sell delta. So the market makers are short. Okay, then as we approach and the delta goes up, they're not short enough, so they have to sell. You know, let's just say they're short a 30 delta, now it's a 40 delta, so they have to sell 10 more deltas worth, but the gamma of it, not the delta of it. So they have to sell as we approach, because they're long these deltas, they're too long, so they have to sell to balance it. Okay, so that's selling as we go up. But then what happens when we pull back? Well, if we pull back 5 points, it doesn't matter. But then as we pull back enough, oh shit, now I'm too short. I sold, and now I'm too short, so I have to buy. And so that creates that mean reverting reflexive chop. Does that explain it? Yeah, we're not going to go into the Zoma, all like the third and fourth order Greeks and, the effect of Volga, the change of volatility's effect on gamma, whatever, all that stuff is baked into it. But at the end of the day, it's baked into the nuances. And as we head up and they're short, they have to sell more to flatten out because they're too short. As we move away, they're now too lopsided in the other direction. They have to buy. Did that explain it? And there's people that'll give you more nuanced explanations, and that's fine. I'm trying to give you the trader, what I need to know explanation. Okay, spot up vola. Caution, yes and no. Let's talk about the spot up vola. So let's back it up a step. What does that mean? So what that means for people that aren't familiar with that verbiage, and we'll talk about it. That's a good topic, Joel. Thank you. Let me find my volatility dashboard. Not that one. As you can see, I'm very organized. Okay. I want the S&P over here. Okay. I want this to be candles. How do I do that? All right, we're just going to leave it like this for now. I changed it for some reason, and I'll worry about it later. Yesterday, the market went up, so did volatility. Volatility was up around 4% at its peak on the VIX. So why does that happen? Well, that happens for a few reasons. One reason, a real simple reason, is volatility is two directional. Volatility is calculated based on a formula strip of options and what people are paying for them. Typically, people are paying more for puts and calls, and they still are. But there's also chasing upside calls, buying them, which increases volatility to the upside. But volatility is still volatility. So we often get vol up, spot up. And yesterday in the 0 DTE, we had an example of that where people were chasing upside, people were short calls and they were covering them, and that creates the spot up, vol up dynamic. That is sometimes a warning sign, 100%, sometimes not. Sometimes that becomes a market regime. Now we had it like, I don't know, 6 or whatever, X number of the last few days, which is statistically highly unusual. McMillan wrote an article about it yesterday, saying he sees a lot of stuff on Twitter saying that it's something to worry about, and he says, don't worry, and he tells you why. I've been reading McMillan for more than a quarter of a century, and I trust him. I trust him. He wrote, what was the options textbook Bible in my day. But yes, it makes for a fragile market, Joel. Absolutely. Absolutely. It does make for a fragile market. We'd like to see something normal. But now we get into another nuance of what's going on here. And 16 is kind of a VIX floor from a hedging perspective. Let's go to the 16. Let's switch gears again. We want to get into the weeds. Let's get into the weeds, guys. And let's look at VIX. Let's just go 14 on the bottom. And let's go 35 on top. Apply. And let's make sure we have the monthly specific. We want the monthly, which is, I think is this one here, the 19th. Okay, yeah, 40,000, 80,000. Okay, that's the right one. So here's the gamma situation. And below 16, we have market makers short, and we have, I won't go into what we have there, puts and calls, but you can see the path here is kind of choppy up. 16.5 stall, 17.5. So we're in this thing. So 16, 15.5 is a natural floor. So it doesn't really have any place to go. So a hedging of VIX is also just going to kind of pull us up. And let's also remember, let's go back to this. I mentioned this in my notes. I don't know if you could see it here. Okay. Yesterday, when VIX was up 4%, the 9-day VIX was up 7%. What does that tell us? It tells us that whatever is going on is more in the short term than in the long term. Typically, the distance between the 9-day and the week is about 2-3 points. Yesterday was a point less. So it's almost backwardated, not quite, but the range narrowed because of short-term stuff. A lot of that was short-term call buying, and admittedly was also hedging for the FOMC and for G. So there's a lot going on under the hood that when we look at these numbers, we have to kind of think about it in a nuanced way and say, you know what, I really don't know. Yep, it's a potential canary in the coal mine. Absolutely. Got to put an asterisk there. Got to also say, well, what's going on and put it into context. And got to put a big ache for humility on myself, on oneself, and one's evaluation. Say, you know what, my model is a toy model. I have some idea, I have some edge. I have to be open-minded enough to say, you know what, if the situation on the ground changes, I got to change my mind. So all that said, I wouldn't, plus there's the override funds. The other source of negative gamma that people don't talk about that much is like the SPXLs and the TQQs and all that that buy near dated options that the market makers are short that, and we don't see that show up that much. And that causes chasing also by the market makers, and that brings vol up, and that contributes to the spot up, vol up. Nomura writes about it. So there's a lot of factors that contribute to this. And is it fragile? Hell yeah. Of course it's fragile. So anyway, yeah. So it's a warning sign. That's also a party on Garth sign until it's not. Yeah, I'm sorry. Yeah, your absence has been noticed. But sometimes reality rears its ugly head. Thank you, Joel. And thank you for the prompt. And this reminds me of the good old days. You know, Joel would bring up a point and then we'd kind of chop it up. And yeah, reminds me of the good old days. I miss you, Joel. So where are we? Let me find. Yep, this looks like the right one. Is it? Yeah, this looks like the right one. I'm really not good with this stuff, so I open a chart, and if it has what I want on it, I leave it there like forever. How do I get this back to candles? I go over here. That's how I do it. See, I remember now. I'm a genius. Okay. And so I like to. This is my little volatility draft dashboard, and I always like to keep. So here was that crazy one that they basically the bottom, the pre-market where VIX spiked and whatever. I had that mark here. And so I always keep yes, gonna take a hedge this week. Stay safe. Thanks, you too, Joel. Um, where are we? Okay. So I always keep VIX and VIX 9-day next to each other. I like to see that relationship. I'm a short-term trader. I like to keep nation skew index. This is one stand demand for one standard deviation out of the money puts. Basically, what your typical hedge. Sometimes I put down here, I put something else. Depends what I want to look at. Sometimes I might put here, I have the move index, the bond volatility index, and bond volatility has been crushed. I might put key decks in there with just 3 standard deviation out of the money stuff. And as usual, when do they buy that crap that I sell them? When we're at the bottom, they start buying 5 delta puts. Not here. Now nobody wants them. They buy them here when we're at the bottom. Well, no comment. Now VVIX is staying healthy, so demand for hedges is still there. VVIX is staying healthy at 100. VIX is staying healthy at 16. So this is not an underhedged crazy market. This is not VVIX. VVIX 95 is normal. This is not VVIX 88, and VIX 14. VIX is not 13 having a bar mitzvah. VIX is sweet 16. VVIX is 100, solid number. So, I'd like to sound a bearish note, and sure, if we pull back 1 or 2%, yeah, but I don't see it. Other than a little, there's nothing dangerous that I see right here, right now. Okay, I'm gonna hop. I overstayed my intended time. See everybody, and like I said, I don't trade iron condors on days like today. I'll look for scalps, whatever. Oh, okay, but let's take a quick look. What's going on here? Well, here I have my little speculative longs that turned out to be a way better idea than I thought they'd be. These are like so in the money. I kind of have it as like a Frankenstein fly. And here I have stuff for November. Here I have December. I just bought a 10 wide. Well, look at this. If I had just bought these calls, they're up $14,000. I bought a 10 wide for like $1.50 or something. And of course, these puts, I don't remember what I did. Of course, these puts are basically worthless. 5 cents, 10 cents. I probably got $1 for them or something when I did it. But in terms of what to do today, I'm not doing anything, but what I might look at, just for fun, butterfly put, go. We don't want January, of course. We don't want yesterday. And that 95 area that I pointed out, that looked like a pretty good attraction area. 60 cents, I like that lotto. Boom, I'm buying it. I like that lotto. And a lot of times I'll do these and I post them on Twitter. I might sell it for 60 cents, buy it for 60 cents and sell it for 95 cents or $1.20, whatever. And I usually do it on both sides, and usually both sides make money. And I only do 1 or 2. I might do more on my regular account or mess around a little bit more. But these are more for fun and for like learning, for you guys to learn as well as for me to learn. And on top, well, we know we're going to stall. We're supposed to stall by the IC whale calls. That's the first place to put it. Now, this is too expensive to play. But what I often like to do just for fun is I'll sell buy a cheap 5 wide over here and then build around it. So let's just say I did that 5 wide. Let's say we pull back 10, 15 points, and then I could buy a 10 wide over here for 50 cents. I'll layer it right into that. Yes, I do live stream during the day, pretty much all day. Yes, I do live stream and I babble I do live stream and I kind of do this commentary. Of course, there's times where I trade. I'm a trader, so a lot of times I'll be just kind of talking and kind of like mumbling to myself or trading or not really saying much or just kind of blurting out comments. I try to put what my trades in for people to see what I'm doing so I can instruct them in how I'm thinking. So the short answer is yes. The short answer is yes. I'm happy to do it. People have guided me, and it's like a paid forward thing, and hopefully, guys learn it. I call it quantuition. It's quantitative plus intuition. There's also another point in the tuition part. I paid my tuition. I've got my scars in the bull ring, being a bullfighter with these SPX things, and so I paid my tuition. So hopefully, you don't have to, because this thing can be a beast. So anyway, okay, I'm gonna go listen to Vol Signals, former market maker. Guy knows his stuff, so I learn from him, and what I incorporate and I explain. Okay, take care, everybody. Have a great day. Be safe. Happy FOMC day.